Hey guys, just want to remind you of the competition again. You have to be a subscriber. We're going to be giving away all kinds of cool stuff. Uh, Silver, gemstones. I haven't even figured out what all else. Leave in the comment section some stuff that you think will be cool to give away. I've got knives, uh, bullets, all kinds of stuff like that. So just let me know what you think and we'll go from there. This story's called Kings of the Wild Frontier, submitted by Tim Price of Sovereign Man. There's a genuine value out there, but much of it is concentrated in pots of gold hidden along the road less traveled. As Warren Buffett said, it's difficult to buy what is popular and do well. And as he said, think different. Simple but not easy. The title of Richard Oldfield's book about value investing. It has, excuse me, it has a young, highly educated population. 60% of its people are under the age of 35. It has a literacy rate over 85%. Almost a quarter of a million new engineers graduate from its universities every year, and its stock market trades on a price-to-earnings multiple of just 5.5 times, with a dividend yield of 13%. Welcome to Iran. If this is one of the investment world's big opportunities, asks Maren Somerset Webb in her FT column this week, it very well might be. The question for foreign investors is whether these attractive valuations offer sufficient compensation for the clear geopolitical and resource-related risks that come with investing today in the Middle East. Nobody knows the answer to that question, but purely from a valuation perspective, Iran certainly looks interesting, albeit with the inevitable caveats that came with frontier market investing. And, it, and not just frontier investing, it's a characteristic of true value investing that any manager genuinely practicing it encounters skepticism or outright hostility on the basis of what often appears to be either constraint, streak, or outright madness. Although there is a growing body of satisfied evidence that value investing is one of the most successful long-term investment strategies, last week we cited James O'Shaughnessy's 52-year study from the U.S. stock market, which saw a $10,000 portfolio of 50,000 stocks with the lowest price book ratios, for example, compounded to over 22 million. It remains on the fringes of acceptable investment practices because it's emotionally difficult to pursue, both for investment manager and investing client. Richard Oldfield, presenting at the Ben Graham Center for Value Investing at the Ivy Business School in January, mentions three attributes often associated with value in an investment strategy: patience, a tolerance for pain, and a margin of safety. Any value investor who remembers the first dot-com boom will relate to the first and second attributes. Any value investor who held the course into 2000 and subsequent years appreciates the third. True value investing ensures what you never consciously overpay for high quality assets. but you may need to wait for the market to wake up to the inherent value you've found. There's certainly no need to rush into bonds. The rolling black comedy that is the bond market lurches even further into the mire of absurdity. Italy, for example, has the second highest public debt burden in Europe after Greece, and yet last week its 3-year bonds joined those of other countries trading at a negative yield. Investors are paying to own debt issued by an insolvent government. In what universe does that even make sense? $5.5 trillion of debt now offers the prospect of guaranteed loss to those investors. I don't think those are investors. I think those are idiots. Electing to hold it to maturity. Last week, Mario Draghi took to the ECB and Eurozone interest rates even further into the twilight zone. Will negative rates improve prospects for banking sector, trigger economic growth? We think the answer is definitely no. But they do reinforce the case for bonds now being an uninvestable asset class, which leaves equities as the logical default. As a logical default option for investors looking for either income or growth. But with the problem of valuation then arises. Which equities offer the likelihood of meaningful capital growth without their valuations having already been dangerously distorted over generous monetary stimulus? Stock markets generally seem to have recovered their praise. Strategist Jonathan Allen of SMBC Nikko writes, I have no desire to tempt fate, but it does not seem increasingly clear to me that in the first 6 weeks of the year, the global financial markets lost their collective marbles, jumping nervously at shadows that were largely of their own creation. Since the middle of February, the MSCI Global Index bottomed on the 11th of February. The markets have little shamefacedly been pulling themselves together, and both equities and commodities have rallied rather respectively. This applies perhaps more strongly to emerging markets. MoneyWeek points out that both pricing in and sentiment towards emerging markets may also have turned. They cite Robert Arnott and Christopher Brightman of research affiliates who suggest that emerging markets appear to have bottomed. The MSCI Emerging Market Index has risen roughly 15% from its post-crisis low in January. Here's how a developing market, we think, is more equal than most. It has a population of 94 million, 50% of whom are under the age of 30. It enjoys a 93% literacy rate. It has average wage costs less than half those of China, and as a result, is the most popular destination for foreign direct investment in Asia. It will be from the implementation of a free trade agreement with the EU this year. A Trans-Pacific Trade Partnership was signed on October 2015, which gives this country preferential access to the U.S. and Japan. These markets already account for 29% of this country's exports and already runs trade surpluses with both of them. Foreign ownership limits were lifted in this stock market in June 2015. This is currently a frontier market, but MSCI is wildly expected to redesignate it as an emerging market within the next 12 to 18 months. that redesignation, and when it comes, will open the floodgates to billions in foreign investment capital. And what's an inexpensive market? Over 50% of the market trades on a price-to-earnings ratio of less than 10 times. Over 50% of this market trades on a price-to-book ratio of less than 1. Welcome to Vietnam. You can perhaps see why our Global Value Fund has a 15% exposure to this market, but it's not even on an indexed basis. Much of it is with the manager whose existing value fund has delivered returns of 297% over 4 years, while the index has returned 16% over the same period. The balance is with the top performing Pan Asian Value Fund, which is now closed to new investors. All of which suggests to us that there is genuine value out there, but much of it has concentrated in pots of gold hiding along the road less traveled. As Warren Buffett said, it's difficult to buy what is popular and do well. And as he says, think different. So once again, guys, remember the competition. Let me know in the comments section the kinds of stuff you might like to see give away. You have to subscribe in order to be considered for the competition. All the previous subscribers, of course, you're considered. All the new subscribers, you'll be considered. Just let me know. I've listed a few things. Knives, bullets, gemstones, silver. You just let me know what else you might think might be cool to give away, and we'll see what we can do. Until then, keep stacking, guys.